Today, we are going to talk about one of the most important and also one of the most misunderstood topics out there. And this is how to manage your investment risk in retirement. When you retire, your relationship with investing changes. You're not building your savings anymore. You're now living off of them. And that shift changes the way that risk shows up in your life. During your working years, if the market drops, not fun, but you can wait it out. You can maybe even invest a little more while the prices are low. But once you've retired, pulling money out during the downturn, that means that you are locking in those losses. That's called a sequence of returns risk, and it can chip away at how long your money lasts. There's also inflation. You might not notice it day to day, but over time, it eats into your spending power. Things like groceries, gas, insurance, travel, it all adds up. If your portfolio isn't keeping up, you're going to start to feel the pressure there. We can't forget about longevity. A 25, 30-year retirement, that's pretty normal these days. That's good news, but it also means that your money has to last for a long time. So the question isn't really, should I avoid risk in retirement? It's how do I manage it wisely so I can enjoy the years ahead without running out of money. Welcome to episode 10 of Second Act. This is a series that we've designed to help Canadians navigate the retirement transition with some clarity and with some confidence. And in this episode, I'm going to tackle one of the most important and sometimes confusing topics, that is investment risk in retirement. We're going to talk about how your relationship with risk changes once you start drawing from your savings, not adding to them. I'm also going to explore some of the challenges like those sequence of returns risk, inflation, longevity, and how those will shape your decisions. I'm going to walk you through some scenarios where it may make sense to take some more risk, also when it's wiser to scale back a little bit. Finally here, I'm going to look at some practical tools and some strategies to help you manage risk, to protect your income, help make sure that your money lasts. Let's get into it. Let's start off here by looking at a few scenarios of what people are doing in real life. I want to start with Nancy. She retired a bit short of her investment target, so she decided to stay fairly aggressive. 75% of her money was in equities. The goal there is that she was hoping to catch up. Now, at first, it worked. Then a market correction hit, and suddenly she was withdrawing from her portfolio while it was down, and that took a toll on her. She had trouble sleeping, and she kept wondering whether she had ruined her plans. Now, especially in retirement, growth is exciting when things are going up, but it's also very stressful when they don't. Taking on too much risk, that can jeopardize your retirement cash flow. Now I want to look at Ken and Rosa. When they went into retirement, they went with a balanced mix, 40% in equities, 50% in bonds or covered call ETFs, and 10% in cash. Now their returns aren't crazy, but their income is steady, and that's what matters most to them. They say that they would rather make a little less and sleep a little bit better. Now, Sam, he went ultra conservative. About 25% of his portfolio is in equities for some growth. The rest is in fixed income and cash. Now, the good news here is that he doesn't have to worry about volatility practically anymore. The bad news is, though, that his portfolio hasn't really grown either. In an environment with climbing prices, he realizes that inflation might be the real risk that he has to manage. Finally, here there is Jade, and she uses what is called a bucket strategy. 2 years of living expenses in cash and short-term bonds, so she will probably never have to sell when the markets are down. The rest of her funds are invested in a balanced portfolio for growth. When the markets dip, she's able to stay calm because she knows that her short-term needs are covered. Now, there is no one-size-fits-all answer here. What matters most of all are your goals, your temperament, and how much uncertainty you can live with. Okay, let's move on now to how much risk that you should have in your own investment portfolio while you're retired. And this is a very difficult but extremely important decision. There's two main situations. One is taking more risk, and two is either taking the same or less risk than you are pre-retirement. Here's something that might sound a little bit strange. Sometimes you actually need to take a little bit more risk in retirement. If your portfolio is smaller than you'd hoped, or if your income depends on it, then being overly cautious, that can backfire on you. Think again, we have about 25 to 30 years statistically to live in retirement. That is a long time, and inflation is never going to go away. Maybe you've always been conservative, a lot of GICs, short-term bonds, a lot of cash. If your investments do not keep pace, then over the decades, your lifestyle will slowly shrink. Yes, some people do need a bit more growth to make their plan work. That might mean holding a higher portion of equities or investing in blue chip dividend paying stocks or funds that provide both income and long-term growth. But this is really important. Don't let fear or urgency push you too far. If you're chasing high returns, you're under a lot of pressure, and that's one of the fastest ways that you can mess up your plan. If the markets drop, if you're overexposed, then there might not be enough time for you to recover. And that risk, the risk of permanent loss, is very real. So here is the key. Add risk gradually and diversify. Keep a short-term reserve for a few years of spending so you're never forced to sell during a downturn. Taking on more risk, if it is done thoughtfully with safeguards in place, may be needed. You don't need to be dramatic on this. Just keep your money working without putting your lifestyle at risk. At some point, you may be one of those lucky ones that realizes that you are exactly where you need to be. You've saved enough to live comfortably and your income plan works. In that case, that is when it is okay to ease off a little bit. Remember, your focus is shifting here from building to preserving. Maybe in your case, your CPP, your OAS, your pension already covers all the essentials, so you don't need as much growth to stay secure. Maybe you're facing health issues, or maybe you just don't want to watch the markets anymore. If that is you, the biggest risk here might not be missing out. It might be losing what you've already built. And I saw that happen too many times during my career. That's when it makes sense to scale back. Shift your focus from chasing those returns to protecting your lifestyle. This could be a ladder of GICs, bonds for predictable income. You may be at a stage where income generating ETFs make some sense, or choose dividend focused ETFs that provide steady cash flow with less volatility. Some retirees even buy annuities to lock in income for life. Instead of chasing the indexes, create your own, create one that fits your risk and your comfort level. So scaling back, that just means adjusting the risk to match your goals and not someone else's. I'm going to use a baseball analogy here. If your plan is already working, you don't need to swing for the fences. You don't need to risk striking out at this point when singles and doubles will work. You just need to protect what you've already built so that you can keep enjoying it. I hope this video is impressing upon you the need to place a high priority on managing your risks as you shift from growing your portfolio to drawing from it, and that transition comes with new priorities. I have talked about stability, income, a smoother ride when the markets get bumpy. On that note, I would like to take a moment and thank Harvest ETFs. They've partnered with us for this entire series, and I want to highlight two ETFs that are designed specifically for this stage of life. First up, HVOI, the Harvest Low Volatility Canadian Equity Income ETF. HVOI blends a disciplined, rules-based approach with a low volatility strategy. It selects 40 of the largest, most stable Canadian companies scored by both size and risk profile, and then it applies a covered call overlay to generate monthly cash flow. That combination can help soften the impact of market swings while still keeping your portfolio productive. Also, HVOL, this is the Harvest Low Volatility Canadian Equity ETF. Similar idea, but without the covered calls. Now, HVOL, it focuses purely on capital appreciation with a lower volatility tilt. It uses the same top-down screening process, starting with large and mid-cap Canadian stocks, scored for risk and fundamentals, and capped at 4% per holding for diversification. The portfolio is rebalanced semi-annually by Harvest's experienced team, keeping it aligned with its low-risk mandate. So if you are a retiree asking, should I go for growth or play it safe? Well, Harvest's low volatility ETFs suggest a better question might be, how do I invest for peace of mind? To learn more about HVOI and HVOL, visit harvestetfs.com or click in the links in the description below. Again, thanks to Harvest ETFs for supporting this series. When it comes to managing risk in retirement, having the right tools and strategies in place, that can make all the difference between having financial stress and lasting peace of mind. I want to look at a few ideas that can help you manage risk in retirement. Let's start with good old-fashioned asset allocation. Your mix of stocks, bonds, cash, this is the single biggest driver of your portfolio's behavior. You can think of it as your financial foundation. Too aggressive, you might panic during a downturn. If it's too conservative, your money might not grow enough to last 30 plus years. Next up is the bucket strategy. This is what our example Jade used earlier in the video. Separate your savings based on time horizon. For example, 1 to 3 years of income in cash or GICs to weather the market dips, with the rest invested for long-term growth. So this structure that provides both psychological comfort and practical stability. Also, the withdrawal strategy matters. Know how much that you can safely take out each year without running out of money. Now, there's this famous 4% rule that is a starting point, but it is very much a rule of thumb. Make sure that you account for taxes, inflation, personal health needs. You need a dynamic strategy that adjusts for varying market conditions. Next up is diversification. Never, ever rely on one stock or one fund or even one country. You should have a mix of sectors, asset classes, and geographies, and that can help reduce the damage from market surprises and provide more consistent performance over time. Now, tax efficiency is important. The order that you draw income from RSPs, TFSAs, non-registered accounts, that can impact your tax bill and your government benefits. Smart sequencing may help you avoid OAS clawbacks, reduce your lifetime taxes, especially if you're starting your RIF withdrawals before the age of 71. I will put a link on the screen here for a different episode of this series that covers this off in more detail. Next up, rebalancing. You need to review your portfolio at least annually to make sure that your risk level hasn't drifted from your target. Lastly here, don't forget about guaranteed income options. Products like annuities, these can add predictability to your retirement income. I do talk about investments of this type in another episode in this series. They're not for everyone, but for some retirees, they do help reduce stress. They do help cover essential expenses like housing, food, and insurance. Now, to be sure, these tools themselves are not going to solve everything. But when you take them all together, these strategies can help you feel more in control of your finances, help you be better prepared for the unexpected, and more confident in the road ahead. Before I leave you, I want to address another very important aspect of investing in retirement, and that is the emotional impact. You can build the perfect plan on paper, but when the markets drop 15, 20% or more, it is really hard as humans not to react to that. And that is why understanding your own personal real risk tolerance matters. In most cases, as I've mentioned, having cash reserves, having some guaranteed income, that certainly helps. It can keep you from selling in a panic. If your retirement income is on track, you don't need to chase higher returns. Remember, there is not a prize for taking more risk than necessary, but there is more room for things to go wrong. Now might be the time for you to shift your focus towards consistency, protecting the lifestyle that you have built. Importantly, this does not mean that you have to be 100% conservative if you're already there, unless you have so much money that you will literally never be able to spend it. But it might mean easing back on some growth assets, putting more weight on income, stability, and peace of mind. Risk in and of itself isn't good or bad. It's simply a tool. The question is how much of it you need and how much of it you can live with. Start by doing a quick check. List your essential expenses, add up your guaranteed income, then look at what the gap is. And that is the part that your portfolio has to cover. From there, you can decide how much risk makes sense for your circumstances. If you'd like a hand figuring this whole retirement thing out, I've created a summary, sort of a cheat sheet for this video, also for every other episode in this series. They're free. You can download your own copy by using the link below or by scanning the QR code on your screen. It'll help you figure things out. It'll identify what changes might make sense for you. In our next episode, we're taking a little trip. I'm going to talk about Canadian snowbirds, so retirees who spend part of the year living somewhere probably warmer. I'm going to talk about the money side of things, taxes, residency, healthcare coverage, but also I want to talk about the lifestyle side, how to make it work as smoothly as possible without any unnecessary surprises. So if you've ever dreamed about escaping winter, but you're not sure how the numbers add up, you don't want to miss that episode. Hit subscribe, maybe share this video with a friend who is starting to think about their own second act. I really hope you're enjoying this important series. Again, thank you to Harvest ETFs for their support. We'll see you in the next video.